Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're taking on a difficult topic. We're talking about macro trends and the consumers with one preeminent expert in it, Marvin Loh of State Street. Marvin is the managing director and senior global market strategist within the multi-asset research team at State Street Global Markets. Previously, he had roles in the FX, rates, investment grade, and high-yield credit and equity markets. He received his bachelor's of science degree from MBA and his MBA from NYU. So welcome back to the podcast.
Thanks for having me once again, Rob.
All right. So first thing we have to ask you is from the nerve center there in Boston, what are you seeing in the data that you collect on flows and holdings and what's it telling you?
Yeah, absolutely. So State Street has the luxury of really having a good look into what the institutional investor is doing. Our custody business gives us a unique perch in that discussion. And what we've seen during the first quarter of this year, and can you imagine that we're only getting to the end of the first quarter? There has been obviously some fairly significant moves. Valuations show that, but the moves have been really getting to a neutral position. So, some of the more extended trades, whether they were overweight dollar, whether they were overweight technology, whether they were underweight industrials, we've seen kind of that real money investor reverse that just to get to neutral. And I think that speaks to the uncertainty that we're all dealing with, uncertainty that's not only just you and I as we talk about stuff, but also that's what I heard from the Fed. They really don't know. But one where getting neutral is very different than running away from risk. So they're just waiting for the right time and the data that gives them the ability to make more aggressive investments, either long or short. It could go either way for sure. Generally speaking, getting to neutral is about asset allocation changes and reallocation from positions that could have been extended on both sides of that discussion.
Right. So let's drill down into a little bit into the sectors there. So, because, what went from overweight to neutral, what went from underweight to neutral?
Yeah, so some of the most extended positions, and we all know that technology, particularly U.S. tech, is an extended long position. They have whittled it down a bit for sure. They are still overweighted. I think it's hard to make an argument that you would want to short that sector. Quality growth is quality growth. Whole different story. Bigger underweights, interestingly, things like automotives. You would think that the investor would run away from automotives. Lo and behold, they've actually been buying some of that, getting back towards neutral. And then globally, when we think about the biggest underweights, Europe has been a massive underweight. And certainly that has reversed itself in very, very quick order.
Yeah, so let's just break that down a little bit because it is sort of illogical in a way to hear that people are raising their exposure to autos. When you think about the impact that if we're going to continue in an inflationary market has on the expenses, relatively tight credit still, and maybe a slightly pinched consumer going forward. So do you have a sense of what's going on there?
You know what? A little curve fitting, ultimately. Us as analysts, sometimes we run the risk of trying to come up with an explanation to price action, and sometimes we're wrong about it. My curve fit, however, with that would be around tariffs, and actually the potential that some of these auto manufacturers might show better than expected performance as people try to get ahead of those tariffs. And we know how complex that manufacturing chain is on the auto side of things, that it probably is cheaper now than it might be in the next 6 months.
Okay, that does kind of make sense because I was reading where certain car manufacturing is the function of the thing that's going to become the car goes across the U.S.-Canadian border 20 times.
Yeah, exactly,
So,
exactly.
yeah, it's mind blowing now. So, it's interesting they're taking in some of their exposure to tech, but that is a very difficult thing to rationalize. How do you think they're seeing that?
I mean, valuations first and foremost, for sure. We, as a general market, had gotten expensive by historical terms. That's not really saying a whole lot. And most of that was on the tech side of things. And, certainly with the trade tensions, potential regional tensions that kind of go with those trade tensions, and the fact that these tech business models are not just U.S. business models, they're global models. Ability to really model your cash flows has become more difficult. And then as a result of that, we as analysts are always more attracted to business models where we can get a good sense of what those cash flows look like.
Right, right. That's the bugbear to everything, right? That's underscoring everything. Well, and I guess I'm also curious about what you think is going on in Europe. Is there, they're raising their exposure to Europe a little bit, which is
They are.
a slow growth, high expense kind of,
Yeah, they are. They are. But even there's a bit of skepticism, kind of in the way we look at the data, and just really how kind of those markets perform. So I'm gonna say this because we might not be able to say this for quite a additional amount of time. Europe is outperforming the U.S. from an equity market perspective by almost 20%,
right?
20 percentage points.
Right.
So I don't know when we're gonna be able to say that again.
I was going to say that's happened for a decade.
Yeah, exactly. But it's been quite narrow. It's the defense contractors, of course, so the large industrial complex, and it's been the financials. Our data kind of shows that those have also, from a real money behavior perspective, been where they've focused on. So it's not as if all of a sudden everyone's super bullish Europe. They were incredibly underweight Europe as an asset class. Something that probably shouldn't exist in a world where diversification makes sense, but they're not, by their actions, buying Europe globally. They're buying things that is easier for them to buy, which is the defense discussion. And it is certainly the financial discussion in a world where rates might be higher.
Yeah, I mean, it's also exceptionally interesting for me to see how tourism has gone in Europe,
Yeah.
which is a significant portion of some of the economies.
Yep, absolutely.
Someone needs to tell those people that the stock market slowed down because they're just heaving. It's outrageous. Well, okay, so I guess some of the things we're sort of talking around here concern the consumer,
Yeah.
the U.S. consumer, to be specific. What lights? I know there's some lights that maybe flashed a little red. Is some delinquency rates came up a little bit
A little
from some
bit,
very low
from
rates.
very low
Yeah.
levels.
So how are y'all
So,
reading the numbers of that?
to me, the jobs market is still, even though it's one of the laggiest of all indicators out there, even if you have survey and response issues associated with what we find every month in non-farm or what we get kind of in the weekly claims number, it is still the most important look into the consumer in the U.S. And from that perspective, the jobs market is still okay. We've done work on DOGE and the potential impact that they have on federal employment, and certainly it's slowed down. There's no doubt that claims in D.C. are leading, if you will, some of the uptick there.
Mhm.
But there are 3 million federal workers in a workforce that for the country is upwards of 165 million people.
Right.
So orders of magnitude, it shouldn't really impact the employment picture unless there's underlying risk within that employment picture. February showed us that the employment situation is still solid, not necessarily accelerating. We're not talking about 300,000 gains per month the way we were last year, but at the same time, it's not under 100. It's not as if we've got negative employment numbers. So it's enough to keep the consumer engaged. So I kind of start there. The other thing that's really, really interesting is that some of the concerns around the consumer are very much driven by survey data. So there's the hard data versus the soft data. Soft data is flashing, very bright yellow, if not starting to move towards red. But that survey data has been quite volatile, and it's interestingly driven by, obviously, our view of the world, and that view seems to be driven to a certain degree by partisanship. Whether or not you're a Democrat or Republican really became a touch point when we looked at the inflation data survey based once again from the Michigan survey report, as well as overall confidence. So very often soft data gives you a tone as to whether or not either business spending and or consumer spending is going to go in a similar direction. I wouldn't necessarily discount that 100%, but I would take it with a grain of salt that there's a lot of volatility and a lot of biases in some of the survey data. One last thing is that, and we were talking about this before we started recording, the administration's ability to control the news flow, just the complete dominance over media is going to play into confidence also. But we have also at the same time seen how volatile their views in terms of policy are. So it could just as easily change in my mind.
Yeah, maybe between now and the end of this conversation. It is exceptionally challenging. I guess the other thing that I'm just wondering about how is part of the pessimism, I think, if I understood some of that soft data around it, is about expectations of inflation. essentially. So is that where you're seeing it in that data as a whole, or are you seeing the pessimism just or is the pessimism just because it's hard to predict what's going to happen?
You know what? I think part of it is the inflation data. Certainly the Fed thinks inflation is going to be higher this year, but the Fed also thinks that inflation is going to collapse again next year. So that they venture to use the term transitory again, as risky as it is. That absolutely is part of the concern out there. But I think that when we hear about what Doge is doing, when we hear about layoffs at the federal level, that also influences our psyche, because we probably know people who have been impacted by that. It's impossible to not be concerned about where you are from a job perspective when you're seeing it not only in the news but around you. But if you continue to have your job, you become less concerned with that. So I think there's a lot of that that's going on at the moment. That's why I kind of lean, if you will, a little bit more on the hard data, because that is how people are going to eventually spend money or not spend money.
Right, but the hard data is kind of laggy, as you mentioned
The
earlier.
hard data is laggy. The hard data is laggy. But at the same time, I don't necessarily see any real catalyst to create a massive economic cliff to be worried about. The fiscal spending, for better or for worse, is quite robust. And what Congress and the administration are talking about is to continue to run big deficits. It might not necessarily move through the parts of the economy that it has over the last 4 years, but those deficits do make their way into the economy. And that money somehow gets spent somewhere within the system.
Right. Right. It does create some level of growth.
Yes,
On some level.
for sure. More and more of it's interest payments. So those of us who get those interest payments could, I guess, turn around and spend it. But yes, it does make its way into the economy.
Yeah. I mean, this is an exceptionally interesting conundrum, and it also sometimes makes me wonder if higher inflation comes along and eats some of the value of that debt out too.
Yeah.
So it'll be an interesting one. Now, I guess the other thing I'm curious about is how you're reading any other things that are diverging in the marketplace. I've had some other folks here who talked about sentiment around stocks, which is diverging.
Yeah. I guess I view the first quarter and the volatility around the first quarter as a bit of a reallocation. I think there's a component to that. Again, overextended positions, whether it was on a currency side of things, whether it was on a stock sector side of things, whether it was on a regional side of things, we did see a lot of movement in capital trying to get to a more balanced position. Certainly, when you introduce as frenetic of a policy environment as we have, it's harder to get real excited about bidding up aggressively when it comes to some of these business models. So, thinking about valuations extended in the tech sector, it's just quite hard if we can either be a partner with China or we could, really have deteriorating trade relations with that. And it is still an important business model for a lot of industries, especially on the tech side of things. That has, to a large degree, flushed out. We've gotten to a point where at least we know potential outcomes on trade. It's not as optimistic as we thought in the beginning of the year, which was, in my mind, a repeat of 2018, let's say, which really wasn't that aggressive given the approach that the administration had during the first time he sat in the White House. It's going to be more aggressive than that. We're pretty much pricing some degree of universal tariffs, in my mind. We could still surprise to the upside in terms of the size of that universal tariff. But having said that, we know how to evaluate it a little bit more. So the degree of uncertainty, maybe if you will, the known unknowns are much clearer, whereas during the first quarter, there were a number of unknown unknowns.
Right. But
borrowing from Mark Twain, if you will.
The number of known unknowns has declined.
Yes.
Yeah. In case anyone else wants to go
we
back to that in school.
completely confused everybody at this point.
Some people are old enough to remember that. Some people had that in school. Well, I guess, the other thing that we talked around a little bit was currencies, which have shifted in some unpredictable ways. Are institutional investors, driving to that direction, or do you think they're doing it agnostic of that?
You know what? I do believe it's a conscious effort, but I also believe that effort was once again based on positioning. Possibly one of the most overweight positions across all asset classes was a long dollar. It was, and I think I've said this on this program before, it's at various points over the course of the last few quarters, it was the cleanest way to play a Trump trade, if you will. Playing Bitcoin was always somewhat of an issue. Kind of the short rates world was always somewhat an issue. Long dollars was an easy way to play American exceptionalism in a world where tariffs were going to create volatility for everyone, especially outside of the U.S., if you will. As a result, the dollar became quite overweight, particularly as we looked into early January. They have certainly been selling down that overweight position. Our most recent data shows that we're pretty close to neutral. So it was so overweight, it took time to get here. And the euro has been a beneficiary of that. And whether or not it was a desire to reverse the underweight in the euro, which was certainly another one of the very notable disparities between the currency market, or if it was accelerated because of everything that's going on with Europe, the budget, the defense discussions, creates an environment where you don't want to be incredibly underweight the euro. So yeah, so it was conscious from that perspective for sure.
Okay. Well, maybe we should leave it there on the concept of conscious decisions going into facing uncertainty. Well, thank you again for being here, Marvin, and thank you for sharing this unique perch you have at the top of the data that comes out of State Street's custody.
Always happy to chat here.
And thank you all for dialing to this podcast. If you're interested in hearing about more of these topics, please do consider a couple of macro sessions that we're going to have at the Ben Graham event at the end of June. You can find all about it at cfany.org.